Welcome back. Well, we have been discussing the impact of geopolitical tensions on the global market. The Indian market is also impacted by these developments. We have the Nifty, which is under pressure, slipping below 22,200. We have Dhiraj Sachdev, who is the managing partner and CIO, Roha Asset Managers, to discuss his outlook for the markets. Dhiraj, hi, welcome to the show. Well, before we start talking about the markets as a whole, wanted your thoughts in terms of the IT space. We have Infosys, which is coming out with its numbers on Thursday. The stock is under pressure ahead of that. What is your expectation on Infosys and your view probably on a stock such as LTI Mindtree, which has been an underperformer and is seeing a spate of resignations?
Hi, good afternoon, Ekta. So if you go by the reported numbers of the largest IT company, TCS, there has been a modest growth. And so far, our guidance is not that optimistic in the near term. So long term, we could expect the adoption of cloud-based applications to increase as more IT work shifts to cloud. Now, there are plenty of new technologies such as IoT or big data and AI that we are talking about. These can sustain healthy growth for IT services over long term. But we think that the sector will underperform in the near to medium term due to growth and demand uncertainty in the US market. So we can only go with very modest expectations across these top 5-7 names that you're talking about.
All right. So what would your positioning on these 5-7 names that you're talking about? I mean, is there a trade here? The fact that the stocks have underperformed and, the growth headwinds are coming about along with Gen AI, and the fact that there is some valuation comfort after this discount or this underperformance that we've seen as well. How do you play this?
Mangalam, we are not playing too aggressively on the sector per se. As I pointed out, the larger ones offer little margin of safety. Many of them, even in the mid-cap category, are not too cheap in terms of relative valuations. And given the modest growth and uncertainty that we are talking about, we only will remain underweight as a strategy on the investment side.
Okay, all right. Well, let's now move to the markets. We had the mid-caps, which have been quite choppy now. How would you approach it in light of all of the geopolitical uncertainty? Do you think that you would probably shift your focus, shift your money towards the large caps and probably take some profits off the mid as well as the small caps?
I think clearly currently Indian equity market is passing through global challenges of heightened geopolitical environment, Red Sea freight related cost issues for exporters, to firming up of US interest rates, bond yields and fewer rate cuts. Including recent spurt in commodity costs, be it oil or base metals. How, despite all these challenges, given the earnings support of India corporate sector and rising retail equity culture or global flows, it is a high probability event that market will sustain rally and the corrections are likely to be sharp but short-lived. So we will not be surprised, but these knee-jerk reactions, high volatility, etc., will be the phase over the next few weeks. But then the corrections will be short-lived. The continuity of reformist government is being anticipated by the markets, and along with better earnings growth will be the twin forces that will push markets to higher levels in times to come. Broadly, we remain positive given strong capex or improving manufacturing cycle, including reforms in the power and renewable sector. Now, on the small and mid-cap side, to be specific, it is unwise to generalize all stocks to one basket, as the category has a vast ocean of universe of stocks, spanning over a few hundred to thousand companies. So one needs to have bottom-up approach to stock picking, despite relative volatility or beta being higher than the large caps. Yes, valuations in many cases may be ahead of earnings or offer less margin of safety compared to 12 months back. But still, one may find opportunities in 3 out of 10 cases from the valuation perspective. So I don't see any reason where, over a longer period of time, select bottom-up opportunities can still far greater relative returns than the large caps. So it's a myth that the large caps will continue to outperform, the mid and small caps over a longer period of time.
All right. And what sectors would you stay away from, and what particularly offers some upside from current levels?
So we are avoiding companies that are largely dependent on exports. So we may be underweight on IT, as we talked about, due to project delays or lower than expected growth and modest growth guidance. We're also watching metals for now, despite the rally that we saw, but we are not very convinced because the structural problems are still there on the real estate side in China. So despite some recent manufacturing activity showing momentum, we're not fully convinced on the metals rally as such, and we are waiting to watch. We may go wrong here, but we are not fully convinced on the rally as such. So these are a couple of large sectors we are avoiding for now.
Okay, all right, Dhiraj. We're going to let you go on that note. Thanks very much for joining in and speaking with us and talking to us about the markets. Well, for the markets, as we've been telling you, it's now become sluggish. So we have the Bank Nifty, which is down around 0.7%. The mid-caps have given up their gains and is now down around 63 odd points for the mid-cap index. The small-cap index, however, is still managing to hold its head above the water. So maybe that should come up for you. It's showing a gain of around 0.4%. The BSE small cap index should be up on your screen as well. Well, we need to take a short break, but on the other side, Manisha Gupta will join in. She has with her Ajay Goyal, the chairman of Wheat Products Promotion Society. Stay tuned for that.